Hello, and welcome to the Bloomberg Wealth Summit, to the panel on the future of retirement. My name is Suzanne Woolley. I'm a reporter on Bloomberg's personal finance team. We have a terrific panel with us today to talk about the future of retirement. We have Todd Jablonski, who is Chief Investment Officer of Principal Global Asset Management. We have Michelle Seitz, who is Chairman and CEO of Russell Investments. We have Eric Stevenson, who is at Nationwide Financial, where he is president of the retirement plans business. Welcome to you all. Thanks for being here to talk about this topic. Michelle, I wonder if you could start us off. I thought maybe this discussion could start broad about the challenges facing the retirement industry that the industry and individuals need to solve for, and then we'll sort of narrow down into some of the products and solutions that are coming up in the industry.
Wonderful. Thank you very much for having me, first of all. And it's a critically important topic, and especially timing wise, not just because of COVID, but because of the magnitude of what we continue to face and what COVID has amplified. So let me start. The previous panel was talking about the fear of missing out and the fact that markets have been screaming ahead, and we've had unprecedented amounts of liquidity. And the Biden administration has done, of course, everything that they can, as well as the former administration, to make sure that we had liquidity to reinvigorate the economy. But the problem is that we need to be equally focused on making sure that we're reinvigorating the balance sheets of individuals and ensuring that they don't outlive their savings. And so just a few stats. The first would be, which I think has been well talked about, but a third of Americans before COVID couldn't withstand a $400 disruption to their income. Many, notwithstanding the payments that have been sent out, still were surviving on credit card debt, which we all know is incredibly expensive in terms of tapping into. And then I would say, just at a macro level, the gap that exists between the retirement savings gap today is $70 trillion worldwide. It will grow to 2050, 2050 to over 400 trillion. That is magnitudes higher than the GDP of various countries. And so this is a critically big and important problem, especially as we all live longer. But the good news is, because it's long-term, even small shifts that we make as an industry and we make in terms of partnership with public policy as well as private and individual capabilities really can close this gap over time. It won't close the gap in the immediate term. So a survey and kind of analysis that we did ourselves really highlighted the fact that only 15% of pre-retirees could afford the lifestyle that they've grown accustomed to in retirement. And so what we do need is a safety net. What we do need is actions being taken, which I'm sure this panel will talk about, in terms of personalized solutions at scale. And the industry needs to have a clarion call, and that is around making sure that we can solve for the liability need, the retirement need, instead of focusing people on beating benchmarks and the like. So again, making this very personalized, very close to home, and making sure that we're solving for the actual problems, not solving for industry, the industry problems.
Great point. Eric, can you talk a bit about what legislation is coming about and what you're seeing in a Secure Act 2.0 that might put us on a better path toward the huge retirement problem that Michelle spoke about?
Yeah, for sure. And thank you again. Thank you for having me as well. And I just want to build off of the points that Michelle made, and just to amplify that a little bit. One in four Americans coming out of COVID has had to delay their retirement plans, and 1 in 5 has either stopped saving for retirement or reduce the amount they're saving for retirement. And if you compound that with the point that Michelle made, the percentage of Americans who don't have, whether it's $300 or $400 saved, we can spend a lot of time focused on big macroeconomic issues. But the reality is that everyday Americans are really struggling to even think about being able to retire. And so that's what I'm so proud of with the U.S. government is doing in terms of whether Secure Act 1.0 or CARES Act and now Secure Act 2.0 of really trying to do things to move everyday Americans in a better position to be able to save and be able to access some of their savings. One in particular, Suzanne, that I'm really excited about is the opportunity for emergency savings legislation. Right now, when we talk about Americans having to tap into their savings, their retirement, their 401k plans for car repairs, and that just doesn't make any sense, right? There's just such a double negative effect. They pay a penalty. It just creates all sorts of issues. This would allow them to access some amount of money without any real tax implication, except for the normal tax. And we're hoping to get that done soon. I know Senator Lankford out of Oklahoma is a big champion for this legislation, and I know he's building quite some momentum around that.
What are some of the other parts of Secure Act 2.0 that you think might come into play to help retirees save more?
So a couple that come to mind immediately is one, pushing out when people have to start taking RMDs. That would be outstanding to put every year that goes back. That helps folks who, right, they can delay some of the tax implications a little longer. The other one that I think is really important is the catch up, to making the catch up larger and pushing the catch up out, giving more people access to that will also really help close the gap that Michelle mentioned in terms of how big it is in terms of people being able to retire.
Another interesting part of it is the retirement lost and found. That's sort of interesting, sort of a clearinghouse for people who may have lost track of retirement plans over the years through mergers and such. What about, can you talk about, we've got these interesting proposals going through government that may help, but on the private side, maybe Todd, can you talk a little bit about how products are evolving to help retirees get a better grip on what their future income stream might be? There's a lot more use of target date funds.
Sure, I think target date funds are a great place to start as you think about the current market for retirement investment strategies and why certain mixes can be so effective across retirement plans. Now, really, when you think about target date, they absolutely proved their worth in 2020. That was a fascinating year in which the S&P closed up 18%, despite dropping more than 20% in just 24 days in February. And during that explosion of volatility, which I think investors had really sort of forgotten, as you know, we'd had a very low volatility model for about a decade. That explosion of volatility in 2020 really awoken investors to the value of a professionally managed target date strategy with the long-term horizon. Through normal, ordinary rebalancings and a return towards that glide path of equity, fixed income, and other asset classes, most retirement investors, in fact, in target dates, had a great experience through 2020, and it sets them up for future success. Now, what I think is interesting is we continue to think about what target date can do. There's also the interesting innovation that can happen as a result of the CARES Act and as of other vehicles to start to blend elements and return streams, such as guaranteed income, into a retirement plan that works not only to satisfy what we think is the right investment approach, a long-term program, from the top-down macro picture and societal sort of governmental legislation on retirement, but also at the individual participant level, where I think there's a growing sense that each participant wants more input, more control into how they think about their future retirement outcomes. And I think target date funds are going to play a long-term role in there, although we do see room for increasing flexibility and customization, either in later years or potentially on a values-based approach.
What kind of adoption? Go ahead, Eric.
I was just saying, it's really interesting how these ideas and the innovation are blending. Todd just mentioned target date funds and what they've meant to the industry, and then how those are being blended with guarantees, in particular in-plan guarantees, which the Secure Act really set us up to be able to take full advantage of. There were a couple of things that were really important for that to happen. One, creating a safe harbor for plan sponsors around in-plan guarantees. Number two, addressing the portability issue that should a plan change providers, that those funds, the participant wouldn't lose the benefit. They can roll that into an IRA rollover. And the third piece is by July of 2022, that piece of legislation is going to require all plans on statements to actually show your balance and projected retirement income. Those things have certainly set us up. And now you've seen a number of innovations that have come from different providers around delivering in-plan guarantees that allow participants to take advantage of their savings and in a tax-efficient way.
Can you give a sense of what sorts of new products we've been seeing? And then maybe we can segue into talking more about how important managing for taxes is going to be for retirement plans in general, whether, not at a 401k, but in the taxable side of retirement plans.
I'll jump in here. I couldn't help but be struck by what we're all saying. And what we're all saying is the product ultimately is all about the person. We talked about lost and found. We talked about target date funds, which are, targeted around a person's age. We talked about auto enroll. It's amazing with all of the R&D of our industry, all of the investments that we've made to do these incredibly esoteric and at times very value add on the margin. But the most profound sustainable impact that we've had on society is auto enroll. Hopefully we'll get to universal access. Defaulting to target date around an age. They're very simple changes. I think Todd said too, making sure that they default to the right asset allocation in terms of risk return, and that you don't let emotion be the greatest value destructor, or frankly, people just don't have time. And then the other one that you said was talking about lost and found. We haven't been good about capturing all the data in real time, easy access, so people can make informed decisions about their future, and then democratize access to institutional quality capabilities around risk return, and then personalizing to values, tax rates, individual needs based on more than just income, which is easy to do. We just need to capture the data. You capture 3 more points of data about an individual, and you miraculously change that trajectory over a 5, 10, 15, 20-year period of time. So I think the most innovative products that we could apply to the industry are certainly around tax efficiency. It's certainly around broad asset allocation and risk allocation. It's certainly access to private markets. But more important than anything, it's redesigning what it is we all do for people to make sure we're designing around them, rather than designing around products that we'll all launch relative to, again, benchmarks or other types of siloed strategies. But I think the more we embrace solving needs at the individual level and being able to do that at scale with technology and data points and plumbing, the quicker we'll solve this problem in conjunction with great policies.
Great. One thing I wondered about is what you see in terms of how individuals use target date funds. I've seen people sort of have 3 target date funds, and they don't necessarily grasp the beauty of what a target date fund is really supposed to do as sort of a one, set your target allocation and go. So can you talk about, perhaps, is there more education that is needed for how target date funds ought to be used by individuals? Maybe Todd?
I'd love to jump in on that because I think that's a key issue. I even recall, before target date really took over in the retirement space, it was target risk, sort of balanced options along an efficient frontier. And even then, participants tended to own multiple risk portfolios, in addition to what we see today on target date strategies. I think what's required is, yes, more outreach, yes, more education, but yes, more of an understanding of what that retirement outcome is going to be expected to deliver and how that meets up with the participants' expectations. Again, we've quoted some numbers around how investors feel about retirement. About a third of workers don't feel that they are currently have saved enough to fully fund their retirement. A lot of what can be fixed there is by providing them a sense of comfort and security by understanding what are the potential outputs of my investment choice, And then with target date, for example, how can you blend in additional layers and features and dimensions? Michelle mentioned this, to improve the outcome with just a little bit more information, to really take advantage of customization where it makes sense, which in our view is a little closer to retirement. On the more distant to retirement, there's a lot to be said for really a continued focus on cost efficiency, where in fact, the more distant to retirement a participant is, cost efficiency matters more. Those early years and the investment success there is a place to really maximize the benefits of a target date fund and its efficiency, with room for perhaps more customization later along the savings path.
We have a question from the audience, which is, do you see a growing trend in unretirement, people working well past retirement age as entrepreneurs? Eric, do you perhaps see that in any data from the retirement?
I love that title, unretirement. I hadn't heard that one before, but yeah, that was what I referred to earlier. Is that a number of COVID has accelerated that, and some of the volatility has accelerated that in terms of people delaying retirement or cutting back on their savings. And I think one way I would love to build again on some point Michelle made is, how do we put the participant or the person, the saver, in the middle of this? And as an industry, one of the things I think we've done a poor job of is helping them think about all of retirement. We often we've really focused on saving, right? Target date funds included, but it's all been about saving. And we've got to do a better job of helping folks start saving, getting at the beginning, and then how do we help them on the back end in terms of turning that into income? Using language that people are very familiar with. Most people are familiar with a pension plan. That's very common for a lot of people. They're not offered as often, but they know that concept. People are very comfortable with target date funds. What I was really excited about is the innovation that's happening around in-plan guarantees is building off of those concepts, putting those on a target date chassis and allowing a person to save until they hit a certain age, let's call it 50. And then at age 50, then they start that savings they've been contributing turns into buying units of income. And then when they hit the magic number, 62 or 65, then they start getting income for life. Very simple product in a framework that they're interested in. And I think that's where this industry is headed. And I think that's where a lot of the legislation is pointing us to. And it will also help them be much more tax efficient in their distributions than if they did that themselves.
I absolutely agree. If I can jump in, I absolutely agree with that. There was a speech that I was giving where one of the participants was in her 30s. And she said that their generation doesn't even think about retirement, and it will likely be a word that goes away. And I agree with that. When we came up with age 65 as our retirement age, and when benefits kick in, that's when most people died before 65. So this was in the late 1800s. So as we're all living longer with healthcare advances, and we have lifestyles that are surpassing savings, I think that we need to rethink the entire concept of redesigning careers and having serial kind of reboots to our education and technical skill set. And so but we still need to have everything that all the participants have been talking about, which is making sure that we redesign these things in very simple ways, so it puts us on a trajectory of success as we outlive what is anachronistic retirement system that was built for a very different 20th century times. And I think we're fast approaching people embracing new concepts and new ways to make sure that they're on a better trajectory for a lifetime.
It seems there's so many gig workers today, and a lot of what we've been talking about are 401ks and corporate retirement plans. And there's just a huge segment of the population that does not have access to that. So that's just, do you see how we might solve for that in any way?
Well, I actually do think similar to Australia that has the superannuation funds. I mean, we're starting to see this state by state and multi-employer plans, MEPs. But there's no question. I mean, that goes to my point earlier that default auto enroll is critically important, and making sure that everyone has access to a system, but most importantly, auto enrolls in a system and defaults to target date funds or something, hopefully over time, that are far more personalized, which we do have up and running in Australia with 6 or 7 different personal data points of how best to default around your current situation. But I think that's critically important.
Question from the audience is, have you seen any changes on any kind of scale in the way people are saving due to migration during COVID? People moving from high tax to low tax areas, urban to rural, and if that's having any impact in how much they can save? Eric,
looking across.
Todd?
Yeah, I'm happy to lead that one off and hear how Eric's response as well. As we think about, principles, collection of data across a variety of plans and participants, to over 7 million individuals. When you think about the sort of data that we've seen, really a lot of the, sort of expected migration from urban centers towards more rural centers that people have forecast through the COVID pandemic has yet to show up meaningfully in the numbers. In particular, too, as you look at some of the more urban rent rates, you're seeing, in fact, a pretty sharp rebound in a lot of the sort of gateway cities and other major cities in the U.S. I think what's interesting when you think about balances and ultimately like how much investors are saving towards their retirement, which the question is really getting at, is that right now we're at the heels of what has been a decade-long run in equities that have really driven the market to new highs. It's also driven accumulated savings balances to new highs. We've also seen essentially since the Carter administration, interest rates on the way down. That's meant that even bond returns meant for stability and income have really added to return levels and asset accumulated values as well. Even at this very, very high level of valuation in global equity and fixed markets, interestingly, there's still this enormous savings gap. I mean, this is what Michelle led with. So despite the enormous accumulation in assets, I think all investors do need to take a look at what are their expectations for retirement, when do they plan to retire. We've covered these features, but then really think about what should I expect going forward in an era where expected returns for capital markets are lower where they have been than probably in a decade.
That's why I thought maybe talking about the tax managed solutions was so critical today, because if we are going to see subpar returns in the next decade or so, it makes the challenge so much more for individuals. What are some ways that people can manage their own retirement savings, the balance between taxable and qualified plans? And could you just briefly talk about some of the strategies that individuals can deploy?
Well, I'll jump in and get us going. And the first, and I know we have a part of our audience are advisors, and I'm speaking to them, and their partnership and their help and the role they play in this is just, there's no substitute for what they do. Because when you talk to individual participants, what you often hear is you ask them where they get their advice from. If it's not from an advisor, it's often from a family friend or a neighbor, and we all know what kind of advice that you're going to get there. So that's the first part. My first part is do not, and I'll give you a stat around Social Security. The number one place, and which is one of the biggest pieces of income that people are going to have in retirement, the number one place that people get advice from is from a neighbor around when to take Social Security. We've done that study over and over and over again. And so pointing people back to advisors and the tremendous assets that they are to participants is key. They need professional help, whether that's if they're in a qualified plan or if they're on their own, they need professional guidance. And I often say to people, it's never too early to start. Really good advisors will start working with you regardless of your level of assets, whether you've got $10,000, $100,000, or $1 million. It doesn't matter for really good advisors. And that's where I point people. And if they're in a qualified plan through their workplace, they have access to it. All of those plans have folks in there that will provide basic education, asset allocation, how to get started, how to reduce your debt. And that's probably the one place we haven't talked enough about is during this time, as debt has gone up and savings have gone down, that's a real challenge. And we have to get consumers back on top of thinking about how do I bring down debt so I can contribute more, so I can save more.
Yeah, I couldn't agree more with Eric. And then I would just emphasize something that Todd said, which is about the importance of fees. I do believe that advisors and clients have gotten the message about fees. And we've had this debate between active and passive for now close to a decade, and it doesn't seem to want to stop. What we don't talk about enough is taxes and after tax returns. And so when it's just shocking to me how many taxable accounts are in taxable products. Just shocking. There are wonderful tax efficient products out there, whether they're in mutual funds. That's been our number one selling product is Russell Investments tax managed solutions. But it just shocks me that so few people even seek out tax managed solutions. Then in separately managed accounts, just making sure advisors on the front line are managing to people's after tax, after fee, and after inflation returns. That's all that matters at the end of the day, is how much money do they have in their pocket to support their lives. And I think the more that we can report in that manner and have the same spotlight on after tax, after inflation returns that we've had on ETFs and passive investing versus active, the better off our clients will be over time.
That's a great point. We have a question from the audience, and it is, could this be a golden age for annuities? Eric, do you want to start off?
I don't know who asked that. Sure. I don't know who asked that question, but I do think it really could be, for all the reasons that we've talked about. And the spin I would add to that, or the piece I would add to that, is in particular annuities that participants are able to get inside of their workplace solutions. Because what will happen there, and what's exciting, is the transparency is going up once it's inside a workplace solution. The fees will absolutely come down, because that's going to be not negotiated one person at a time now. But let's say that, whether you work at Nationwide or Principal or Russell, that plan sponsor is going to be negotiating those fees. So that's going to come down. The oversight is going to be better. And the series that Nationwide has introduced are target date based. And so the liquidity, right? They're not the CDSC fees. And so the liquidity is there for the participant. So I really do see this over the next, I call it 5 years, in-plan guarantees really taking off. I mean, there's still a place, and always going to be a place, for retail annuities, but there's going to be this balance that will be important.
Mm-hmm.
That's great, because one of the criticisms of variable annuities has been the high fees, and that seems to be changing.
No doubt, it's certainly changing. And what will be key, Suzanne, is for advisors and consultants also to get on board and start to understand how it's changed, and that this is not your father's annuity. So I think the future is really, really bright.